This video is an Aerodrome finance tutorial, which is the leading DEX on the Base network from Coinbase. There's two things we can do on this DEX. The first is swap tokens if we want to do that. And the other is to actually add liquidity onto the DEX. And that means we can earn the trading fees from other traders that are swapping and earn some yield on our assets from those fees. I'll show you how to do both of these, and I'll leave timestamps for that down in the description. I'll leave the link to Aerodrome down in the description, but it's aerodrome.finance. I also suggest just checking the URL on their social media just to make sure you're not going through to the wrong place. And then on that site, we can press connect with our wallet. So I'll press connect here, and then I'm just using a browser, so browser wallet. If you don't have a wallet set up, I'll leave links down below to a MetaMask and Rabby tutorials. Both wallets are great. They support the Base network, and those videos show you how to add in the Base network to MetaMask if you need. But assuming you have a wallet set up, so we can connect to Aerodrome now. So Aerodrome is actually a bit like Curve Finance, if you've ever used that on the Ethereum mainnet. But this is on the Base network, so very, very cheap fees. So that's obviously good for us. And it's its own liquidity pools, so we can swap any assets that are on the Base network, which isn't a massive list as of right now, but it's obviously growing, and you're getting much cheaper fees. And obviously we can earn trading fees from traders on Base as well. So once you've got your wallet set up, what I can do is show you here on Rabby anyway. You don't need to add the Base network into your account or anything like that. It just automatically connects to the Base network on Aerodrome. But of course, we need some ETH in our Base network. Base network uses ETH for gas. So we need to actually get that into our Base network. So what I'm going to do is just copy my wallet address. So that's this one. And then from here, what we need to do is go over and actually get some ETH into our wallet on the Base network. So I'm just going to do that with my Binance account. Now, for right now, Binance, OKX, and Bybit, I know for certain, actually let you withdraw ETH over the Base network. So if you don't have a Coinbase account, it doesn't matter. So I'm just going to withdraw ETH. And as you can see here, you want it on the Base network. So withdraw that over Base and then get some ETH into your account. Now, you need ETH for gas. So you need to pay a little bit. It's not going to be expensive, but you do need some ETH for gas. And of course, if you want to swap assets, then you can have any asset in your Base account. So you can use ETH as value on the exchange to swap ETH for any other asset. Or if you have the ability to withdraw any other token that you have and you want to trade, you can do that too. But you always need a little bit of ETH for gas. I'll leave links below to Binance, Bybit, OKX. They give deposit bonuses as well if you're new. So, can check the details via those links. Now that we've got some value in our wallet, we can go ahead and swap that for anything else. So come to the swap feature here. And then this is the token that you'll be selling. So you don't need to use ETH. You can use any token, but you do need ETH to pay for the transaction and the gas on the network. So you can use ETH for both of those. So I'll choose ETH here as value to trade. And then what do I want to swap it into? I'm going to swap it into a liquid staking token. So these tokens are Ethereum that's been staked. And so they have the same price as the ETH token, but they also accrue the staking rewards, which right now is about 3%. So, why not have them if you're just holding ETH anyway? So I'll choose Coinbase ETH, which is Coinbase's liquid staking token to swap into. And you can choose an amount to swap, as you can see here. So this shows you exactly what you're doing. You're actually swapping ETH into wrapped ETH. That's going through to trade against CB ETH. And you can see that this is trading through the volatile liquidity pool. We'll get to that later, but it doesn't matter. It's just going to give you the best trade at the current time to swap your assets. So you can see what's happening here. The exchange rate is this. This is the slippage that's applied. So we can adjust this. So of course, slippage is the difference between the price quote that you're given now and the actual price that is traded when that goes through on the blockchain. There may be a small difference here depending on many factors. With a big liquid pair like this, 0.1% or 0.5% is fine. So I'll just choose 0.5%. And then down here it says the price impact is minimal. So that's absolutely fine. We're not going to have a huge amount of slippage or nothing's going to go wrong. And then we're going to have to go and swap them. So I'll choose swap ETH for CB ETH. And that's just going to confirm it in my wallet. So it doesn't matter which wallet you're using. It's all going to be the same. So you can see what's happening here. I'm swapping a little bit of ETH. And it shows me what's happening here. So I'll just sign and create that. And you can see the gas fee is 13 cents in ETH. So not too, big there, and that's pretty much traded. So that's how you go ahead and trade one asset for another. Now it's pretty easy. However, it's going to be important to use this when we are adding liquidity into the DEX, because we have to get 2 tokens to add liquidity, and that will allow us to add that liquidity and earn trading fees from other traders. Let's move on then to adding liquidity into the DEX to actually earn trading fees from people that swap tokens, just like we did when we swapped those 2 tokens now. So when traders pay a fee to swap tokens, that fee actually goes to people that provide liquidity onto the DEX. What is providing liquidity? Well, every single liquidity pool is made up of 2 or more tokens, because of course, when you swap a token, you sell one token in, and then you take the other token out of the pool. That's how a decentralized exchange works. So if you want to swap ETH for CB ETH, which is what we just did, what we actually did is put ETH in and took this one out, and we paid our trading fee. That trading fee doesn't go to Aerodrome, or a little bit does, but most of it goes to the people who actually provide these tokens on the DEX so that we have liquidity to trade with. So this is how the DEX works. When those guys pay a trading fee, that trading fee comes back. This is the trading fee, comes back to us if we provide liquidity on the DEX, known as LP, or liquidity provider, right? And of course, Aerodrome is a new decentralized exchange. And what happens as well is that they actually have their own token, and they actually use that token and the value of that token in the market as an incentive to incentivize liquidity providers to put their tokens there, right? So that they actually get a better yield. So that goes through as well. So if you provide liquidity on the DEX, you get trading fees from traders when they pay, and you also get any incentives that may occur from the exchange. The thing that we need to focus on from these pools is, do we want to hold these assets anyway? And the second thing is, are there any other costs or risks associated with this? And the answer is yes to that. So the first thing is, when you put assets into a pool, you now own 2 assets. So you need to make sure that you actually want price exposure to those assets, because what always happens on these exchanges is that the highest APR pool is some random coin pair, and they're totally volatile. You don't know what they are. And of course, you don't want price exposure to that. Just because the APR is very high, it's very high for a reason. And that's because those 2 tokens are extremely risky, go up and down in price, and that's crazy, right? So we don't want price exposure to that anyway, right? The second thing is, we have to worry about impermanent loss. Now, impermanent loss is something that happens in these liquidity pools. And the way that it works is, when you add tokens into a liquidity pool, you add token 1 and token 2. And they have an exchange rate between them when you add them into the pool. Now, if that exchange rate moves like this during the time that you have the tokens in there, you're going to suffer this impermanent loss. And of course, if you are putting volatile assets in a pool, like 2 altcoins that are going to change dramatically in price, you're actually going to suffer this impermanent loss, which is a cost and takes away from the APR. So the APR may seem very high for these random tokens, and you think, well, the APR is really high, I'm just going to put my money in. But what you're actually also suffering is this impermanent loss. So as you can see, as you put 2 assets in a pool, they go in at a price level, right? An exchange rate between them. If they never move from that exchange rate from when you put the coins in, you never suffer impermanent loss. So that's fine. But if the coins move in price, you are going to have a big loss from impermanent loss. And so the high APR is compensation for that, but you have to work out the net difference, right? So if you have, 80% APR, but you make 90% impermanent loss, you've actually lost 10% despite the APR. So impermanent loss is something that we have to be aware of. The actual yield that you get is the yield from trading fees minus any impermanent loss when you take the coins back out. That is your net profit from providing liquidity. This is why the vast majority of people only add liquidity into these type of DEXs with 2 tokens that are very similar in price. So what would that be? 2 stable coins, which should have a dollar price and not move from that. So that's going to be stable, right? They're $1 when they go in, and they should be $1 when they go out. 0 impermanent loss. And so you can just look for the best paying pools and gain access to yield with no impermanent loss. The other thing people will add is tokens that are very similar. So on ETH staking tokens. So let's have a look at the symbols here. If I type in ETH, it should give me a lot of the ETH token pools. So for right here, if we scroll down, we should see some ETH staking derivatives. So this is one right here. This is a pool with wrapped ETH. So that's just Ethereum. And then wrapped staked ETH, which is Lido's liquid staking token. So wrapped staked ETH should have the exact same price as ETH, plus or minus a couple of percent. But it's pretty irrelevant, the price difference, right? If we go down, you see this one is Coinbase ETH, so the liquid staking token, and ETH. Again, those two are pretty much exactly the same thing, and so they're not going to suffer from any impermanent loss. In fact, CB ETH does earn yield from staking ETH, and so these two tokens are not going to be exactly 1 for 1, right? So ETH is 1, and that price is going to be the reference price, which is 1. CB ETH is actually going to accrue the staking rewards each year, which right now is about 3%. So what we can actually do is go through to a impermanent loss calculator. I'll link this down below as well. And we can work out, if we provide liquidity for a year, how much impermanent loss are we going to suffer? So what we know is that token A is ETH, and we know the price is whatever that is. It doesn't matter. You just have to work out the relative difference between them over the time that the tokens are in the pool. So ETH is the reference asset, and that we can just put that as $1, right? You don't need to put the actual price of ETH. That's just the reference, which is 1 unit. So 1 unit of ETH. And we know token B is Coinbase ETH. And over a year, that's going to outperform ETH by about 3% because that's the staking rewards on Ethereum right now. So let's just call that 1.03 because that will be the price difference between the two tokens, at the end of the year, right? So there's a 3% difference between the tokens between when you put them in. And a year later, if you take them out, there'll be a 3% difference. So let's do 1 and 1, and then 1, because that's the future price is 1.03. You can see the impermanent loss is 0.01%, so completely irrelevant, especially if you're getting 17% yield on this pool for right now. So that's how you can work out impermanent loss. And for more volatile tokens, you can work it out yourself as well. But it seems like when the prices move a little bit, it doesn't matter, especially if you're getting compensated from the trading fees in the pool. Now let's look at adding some tokens into a liquidity pool. So I've searched for pools here with CB ETH. This is the liquid staking token we just bought before. And what I want to do is essentially have price exposure to ETH and earn the trading fees. And I know that a liquid staking token like CB ETH in a liquidity pool with ETH isn't going to have much impermanent loss, and the trading fees are going to more than make up for the very small amount. So you can see a volatile pool and a stable pool here. For us, this doesn't really matter because what's important for us is the tokens that we're putting in and do they have impermanent loss, which they don't, or very small, and the trading fees. So I'll choose this one right here. From here, it says this is the pool that you have. So it's the volatile AMM with these two tokens. The trading fee is 0.3%. This is the APR, probably yesterday's APR. This is going to change dramatically based on trading volumes and how much fees are paid. But it's a decent APR for now. And these are the two assets in the ratio that we need to add them. So if you have a token that you need to put into the pool, you can just put an amount in here. Now, the first and second token, we need to own these in our wallet, and we need to own the correct amount of them because there's a ratio of these two tokens in the pool, and that's the exchange rate. We need to add these two tokens in the same ratio that they are in the pool. So we need to work this out before and make sure we have those tokens. This can get pretty complicated as well. There's a much easier way to do this, which I'll show you in a second, but just to show you here, we've got the pool that exists already. We have the CB ETH token that we bought, and then we have the second token, which is wrapped ETH. Everything uses wrapped ETH. So if you don't have wrapped ETH and you just have ETH, go over to swap your ETH for wrapped ETH, WETH, you can see that token here. That won't trade, that will actually swap, because what the protocol will help you do is wrap the ETH into wrapped ETH, which is the token that you need to represent ETH. Gets complex, I know, but wrapped ETH is a token that we can manipulate. ETH isn't. So just use that to wrap it. It's not a trade. You don't pay any trading fees, but you need that wrapped ETH. So you have the two tokens here. What you can see on the right-hand side is what's going to be happening. Now, these tokens shouldn't have much slippage, so keep that pretty low. And then you have to allow these tokens. What you're doing is allowing the protocol to go ahead and manipulate your assets. You can allow this one, you can allow this one, and then once that's done and allowed in your wallet, you can go and add them into the pool. Now, as of making this video, I've tried to add these. There's some weird error that's happening at the moment. It's like an RPC error, and so it's not letting me actually allow the tokens to put them into the pool, which is annoying for this video, but essentially this is what you do. Allow, pay transaction fees for allowing, then add them into the pool in the ratio that they want, and then you have an ownership of that pool. Can't show you because there's a weird error that I can't work out right now, but you would have a percentage ownership of this liquidity pool, and you'd be earning this APR on what you add into the pool. What you're doing by adding these tokens in is now owning a percentage of the pool. The pool has some amount of TVL, right? So if, let's say it has 1 million in TVL, you put 100,000 in. So you've got 10% ownership of the trading fees that come to the pool. But anyway, that's 70% of whatever you have in right now. So if you go to your dashboard, that's going to show you all of your positions. So when you add these tokens in, what you get essentially is like a receipt which tells you how much of the pool that you own, and it tells you how much of these tokens that you've added into the pool. So this is good for two things. The receipt obviously tells you how much you have in ownership, therefore how much in fees that you should be getting every day. And also it lets you swap that back in for the tokens if you want to take them out of the pool. So what you can do is go to your dashboard, and then from here, it's going to show you all of your different pools and the receipt tokens that you've got, how much you've added and everything like that. And so what you can do here, if you do have a position, it's going to read that in your wallet. Right here, you can click on all of your positions. And then from here, there should be a button that says, do you want to withdraw these assets? So basically you swap in your receipt token and you get your assets back. You have those in your wallet, and then you can go and use them in any way that you want. Like I said, unfortunately, there's a weird error right now where I can't add them on this site, which is annoying not to show you. But it's very simple to see any assets that you have here in terms of your receipt tokens. You can see those and then actually withdraw them to get your tokens back. So yes, that can be very complex with all of the transactions, and you have to work out how much of each token that you need. So what a lot of people may use is a type of aggregator. And so there are a few out there. I don't want to promote any individual one, but essentially what they do is they're like a front end that makes things a lot easier and just allows you to do all of those transactions basically with one transaction. And it's like a dashboard that you can use. So what we actually want to do here is we want to earn those trading fees on the assets that we want to hold. And with these exchanges, you're getting trading fees and also, like I said, trading fees and incentives. So what we actually want to do is wrap up all of those trading fees and all of those incentives and everything else. We want to wrap that into one, right? And have that yield back. Now, doing that ourselves gets laborious because you're going to get paid incentive tokens in the Aerodrome token. Maybe you want that, but maybe you don't. And what we really want to do, a lot of people want to do, is they want to take all of the rewards and they actually want to farm it back into the actual token that they want more of, which is usually ETH, right? So what you can do here is add to a pool, get all of the fees and the rewards. And then really what you want to do is you want to kind of farm them back into the pool. And that increases the yield of the token that you actually want, which is ETH. Now, of course, if you just want to keep the Aerodrome tokens that you get, if you get any of those rewards, then that's great as well. But I'll just show you here as an example on Beefy. I don't want to promote any platforms, but this is one of the most popular. So this is a yield farming aggregator essentially, and it automates all of this. So you can see all of the different blockchains here. Most EVM chains are supported. So if we go to base, you'll see Aerodrome here. So we can go to correlated. That's what we want. Remember, we don't want any impermanent loss. So I've got ETH, and you can see Aerodrome positions here. So like I said, we had that ETH and CB ETH pool. That's actually this one here. And it's showing that the yield is around 16.8%. That can change depending on the information that Beefy gets and everything. So it might be out by a few percent. But we can see a couple here, right? We can see the BASE ETH pool, the wrap staked ETH pool, and then the RETH pool on Aerodrome as well. And there are also others, right? Balancer as well on BASE. So what you can do is say, okay, I want ETH, CB ETH, that's the pool we looked at before. And as you can see down here, it just gives you the APY over time. And we can see the strategy that's happening. So it's low complex. There is very low or zero IL, impermanent loss. You can see the other details here. This is the pool that we just looked at on Aerodrome, but we don't have to go through all of that stuff. What we can do on something like Beefy is just deposit. So instead of going into Aerodrome, having to then swap ETH for CB ETH and then wrapping ETH and then making sure we have the correct ratio of each so that we can put assets in the pool. What you do on something like Beefy is just say, look, I've got ETH here and I've got an amount of ETH. And what they're going to do is say, yeah, no problem. We are going to take all of this. We're going to swap the ETH for CB ETH. We're going to wrap the ETH. We're going to build the LP position. We're going to deposit and everything like that. And that's what all you do, right? So you actually just add in the token that you want, one token, and it does everything for you in one transaction. If you want to know exactly how to use Beefy, I'll leave the specific video guide down in the description because there are many specific things that you'll need to know about building pools in here, because Beefy is using the other decentralized exchanges, and giving us a dashboard on top. So there are many different risks. Right? You have the risks of the DEXs that you're using, like Aerodrome or the others. You have the risks of the assets that you're using and holding, because they can go up and down in price and have their own specific issuers, right? Because you have centralized entities issuing the liquid staking tokens or the stable coins or anything else. You have liquidity pool risk, because during times of high volatility, things can get a bit crazy and things may get out of whack in terms of which people are trading which tokens, which has happened a lot in the past. Protocol risk of all the smart contracts and everything that's being built. And you're using, smart contracts upon smart contracts upon smart contracts. So you're kind of layering many different failure points within that just to earn a certain amount of yield on top, which may be worth it and it may not be worth it. And there's just outright rug risk or something happening that we're not aware of. And so I just want to highlight the many risks that can, appear when just trying to earn a little bit of yield from our tokens. But that's how to use them. And I'll leave the specific guides for Beefy and some other liquidity pool videos down in the description as well.